This week could redefine the mortgage landscape as we face not just a critical Federal Reserve meeting, but one of the most impactful political events, the US election. With rates already hovering near 7%, the stakes are higher than ever. What's next for mortgage seekers? Will we see a new surge? Or could a shift finally be on the horizon? Let's break down what this means for you. But before we dive into what's coming, let's quickly take a look at the past week, what drove mortgage rates, and how that sets the stage for where we are starting this week. Then, we'll explore the major economic data and events that could impact mortgage rates. Monday, October 28th, mortgage rates began the week at 7%, reflecting upward pressure driven by anticipation around the US economic data and European bond market influences. On Tuesday, October 29th, the consumer confidence report came in at 108.7, well above the forecast of 99.5 and the prior 99.2, signaling stronger consumer optimism and economic resilience. This pushed the rates to 7.03%. And then on Wednesday, the ADP employment data showed a surprising increase to 233,000, exceeding the 115,000 forecast, paired with Q3 GDP of 2.8%, slightly below the 3% estimate. But with the core PCE inflation at 2.2%, the mortgage rates dipped to 7.02% as the market balanced mixed signals. Then, on Thursday, October the 31st, jobless claims dropped to 216,000, under the 228,000 forecast, paired with consistent core PCE inflation at 2.7% year over year. Rates rose back to 7.09%, their highest since July of this year. Ending the week on Friday, November the 1st, with a weak non-farm payroll report, despite a weak non-farm payroll report showing 12,000 versus a forecast of 113,000, rates held steady at 7.09% as the market shifted focus on the upcoming US election and the Fed policy decision. These data points illustrate a complex backdrop where strong consumer confidence and labor market indicators maintain upward rate pressure, while mixed economic results add caution, setting the stage for a volatile week ahead. Next week is packed with major events and data releases that could shake up the mortgage landscape, including a critical Federal Reserve decision and obviously the US election on Tuesday, November the 5th. Let's go through what to watch and why it matters. On Tuesday, we have the ISM Services Index for October. This report is a key indicator of the health of the service sector, which makes up a big part of the US economy. If the index shows strong or better than expected results, it suggests steady consumer demand, indicating that the economy is resilient and inflationary pressures may persist, which could put upward pressure on mortgage rates. Also on Tuesday is the US election. The election could be a major factor for rate volatility. Historically, market sentiment can shift depending on the expected outcome and its potential impact on the economic policy. If we see a red sweep with full Republican control, rates might see upward pressure due to the expectations of policies leading to higher Treasury issuance and inflation. Conversely, a divided government might stabilize the market. On Thursday, we'll get the FOMC interest rate decision, followed by Fed Chair Powell's press conference. This is arguably the most significant event of the week. Markets will be keen to see if the Fed signals any shift in its current rate reduction path. If Powell hints a potential pause or expresses caution about further cuts in December, it could create upward pressure on mortgage rates. Conversely, if the Fed maintains its dovish approach, mortgage rates might stabilize or dip slightly. Thursday also brings the initial jobless claims report for November. This report will be closely watched in light of the Fed's decision. An unexpected spike in jobless claim could indicate a cooling labor market, suggesting that the economic momentum may be slowing and reducing inflationary pressure, which might ease some rate pressure. Wrapping up the week on Friday, we'll see the preliminary consumer sentiment report for November. Consumer sentiment gauges how optimistic or pessimistic people are about the economy. A strong report can reinforce expectations of economic strength, which could support higher rates. A drop, however, might suggest a potential cooling, possibly stabilizing rates. For home buyers and refinancers, understanding the impact of these developments is crucial. With rates consistently above 7%, decisions on whether to lock in now or wait are more strategic than ever. If the Fed hints at a pause or signals caution about another rate cut in December, which by the way is largely expected, it could trigger a spike in rates. Locking in your rate before this decision could protect against any unexpected increases or prolonged rate stability. However, if the Fed's tone remains dovish or economic data suggests a slowdown, rates might edge lower, making it worthwhile for those who can afford to wait. This approach, though, comes with the risk of market volatility tied to the US election and other economic indicators. Staying informed in a week filled with high-stakes economic reports and political uncertainty is key. Whether you are in the market to buy a home or refinance, considering how these developments could shift mortgage rates will help you make the best financial decision. Don't forget to subscribe to my channel and turn on notification to stay updated on these critical market shifts. I'll be breaking down the results of the election and the Fed's decision as they unfold. And let me know in the comments, do you think mortgage rates will keep rising or are we due for a reprieve? Your thoughts and questions drive our discussions, so don't hesitate to share them below. Thank you for watching.